Hello, everybody. In today's segment, I'd like to talk about meal deductions. Now, I know a lot of times meal deductions there's a big misconception out there as far as what is deductible versus what is not deductible. So I thought I'd just clear that up because a lot of people misuse the meal deduction, assuming that it is deductible. And there's really two sections that I'd like to talk about. There's the 50% deduction, and then there's the 100% deduction. There's other small areas, but like for truckers or for whatever, and that's typically like 70%. I wouldn't worry about that because a lot of people don't take that into account. But the first one I'd like to talk about is the 50% deduction. Now, when you as a business owner or as an employee take a client out for lunch or for dinner or whatever, is the portion, and typically you go out and you kind of share a meal with them, right? You go to Olive Garden or you go to wherever you go, right? And the 50% is the the potential client's portion that is deductible. The IRS knows, of course, you need to share a meal with them. So the portion that is yours is not deductible. So it just, in doing this, keep in mind a couple things. Obviously, it needs to have a clear purpose. Just don't go to any random meal with just a random person. And it must be ordinary and necessary. So you want to, grease the wheels as far as closing the sale. You want to expedite the sale purchase so you can get some money. You need to do it, of course. And just make sure it's with a client or with a prospective client. Um, or meals for employees while traveling, or just board meetings, whatever. But it needs to be ordinary and necessary, right? The second one is 100% meal deductions, and in that's more for a couple things, like fringe benefits and employer morale. So the first one, employer morale. Let's just say you have a Christmas party, or let's just say there's a birthday party you need to celebrate. That's 100% deductible because that's considered for the client, for the employees of the company. The other one, fringe benefits, if you get coffee for the office or, water, snacks, things like that, just to kind of keep people moving. And that's deductible. What is not deductible, and I see this a ton in doing people's bookkeeping, is when you go to Starbucks for yourself or you go to wherever for yourself, that is not deductible. And you're on location of your office, or, you make a quick Starbucks trip, not deductible. So if you get that latte, forget it. But other than that, just kind of, and one of the things I would definitely, in all these different deductions, make sure you keep, if it's $75 or more, make sure you keep your receipt. Because always worst case scenario, the IRS comes and audits you, all you have to do is hand them, wherever you keep your receipts, there you go, do your thing, and we're done. I'm sure as a business owner, you're busy running around. So anything $75 or more, keep the receipt. Make sure in either scenario, who was with, what was discussed, and the date of the transaction. That'll kind of keep everything clear. So worst case scenario, you just wherever you've been keeping your receipts, everything ties to your bank statements, everything ties to the tax return. And even if you do it off your personal debit or credit card, or just use petty cash, whatever, keep that receipt. So because there's no trail as far as what's done. So this will definitely help you clear out a lot of things that you may or may not be doing for your business, or you just may just forgot about. So definitely keep that in mind. Just a little bit about me. Myself and my partner, we have a bookkeeping business that we've had for over 15 years now, right there. There we go. www.metroacc.com. Check us out, like and subscribe for more information.